So we now know if we are performing a valuation using earnings multiples, either we can perform the calculation using a price earnings multiple or market value of invested capital over earnings before interest, tax, depreciation, and amortization. First, let's look at price earnings multiples. Now, what I've done in your lecture notes is I've broken the calculation down into 3 steps. But I don't just want you to study steps, I want you to understand the logic behind where those steps come from. So please remember, if we are performing a valuation using a price earnings multiple, we calculate the value by taking maintainable earnings from our company that we are trying to value, and we multiply that by an adjusted PE multiple. So you can see in step 1, you need to calculate maintainable earnings. In step 2, we are going to calculate the adjusted PE multiple, and in step 3, we are going to bring everything together in order to calculate the value. So if you just skip forward in your lecture notes, you'll see step 2 is where we calculate the adjusted PE multiple, and step 3 is where we calculate the value. So that is the logic behind the 3 steps. Now you need to study these steps. This is a framework. I'm now going to go through the detailed example with you. And as we go through the example, I'm going to work through each of these steps. So if you study the steps or the framework, you can then apply these steps to any question where you are required to perform a valuation using price earnings multiples. All right, so instead of just reading through the steps with you, let's skip forward to the example. And as we work through this example, I will show you how to perform the calculation under each of those steps. So in this example, we have information on Clarity Furnishers Pty Limited. So once again, we are dealing with a private, unlisted company. And this is a small family-run business, and they specialize in the manufacture of furniture. The company was founded 20 years ago by the Clarity brothers and has since been trading with varying degrees of success. So the company has been around for quite a long time. It was founded 20 years ago. The company's 2 directors, namely John and Jacob Clarity, each own 50% of the shares in the company. All right, so the company was founded by the Clarity brothers, John and Jacob. Each of them hold 50% of the shares in the company, and they are also directors. Then just below, we have an extract from the statement of profit and loss and other comprehensive income for the year ended 30 June. And we are given this information for a period of 3 years, for 20x4, 20x5, and 20x6. Then on the next page, we have additional information, and we are told that the net profit before tax was calculated after taking the following into account. So if we just go back, this line item over here, net profit before tax, includes the following items. First, we have dividends received on a listed investment, and we have more information on this in note 1. The listed investment has a fair market value of 180,000 Rand on the 30th of June 20x6. Then we are given information about directors' remuneration. And in note 2, we are told what a fair director's remuneration should be. So in each of these years, you are given the fair remuneration. So we can see that these directors are actually being paid less than a fair remuneration. We then have an inventory write-off, and this was in 20x5. In note 3, we have more information. The inventory write-off of 200,000 Rand in 20x5 relates to inventory that was damaged in a fire. Clarity Furnishers Pty Limited was reimbursed 158,000 Rand from their insurers, which is also included in profit before tax for that year. We then have a profit on disposal of equipment in the most recent year. We also have impairments. So first we can see machinery was impaired in 20x4, and then we have trade receivables being impaired in 20x5. Now please note, an impairment of trade receivables is just bad debts being written off. And lastly, we have interest paid on long-term borrowings in each of those years. So all of that has been included in the profit before tax figure that we were given above. We are then told that a trailing PE multiple of a similar listed company is 12. So please remember, a trailing multiple just means it's a historic multiple. And this is not reflective of a controlling shareholding. I'll discuss that with you in more detail when we actually get to the solution. Despite a general decline in the furniture manufacturing industry, earnings of Clarity Furnishers are expected to grow by 9% per annum for the next 5 years. And this is due to lucrative government contracts to provide furniture to local schools. In terms of the memorandum of incorporation, a shareholder who wishes to sell his shares must offer them to the other shareholder at a valuation determined by an independent valuer. John Clarity has decided to retire, and you have been asked to perform the required valuation of his shares so that he can offer them to his brother, Jacob Clarity. Now, please note, while we are here, we were told up front that each of the brothers hold 50% of the shares in the company. So if John is going to retire and sell his shares to Jacob, that means after the sale, Jacob will own 100% of the shares in the company. So please note, we are performing a majority valuation. We are now going to perform this calculation by working through the steps that I provided you with. So go back to step 1. In step 1, we need to calculate maintainable earnings. Now please note, when you are performing this calculation, the earnings must be after interest and tax. And the logic behind that is, when we multiply by the adjusted PE multiple, the multiple of the similar listed company is also after interest and tax. And I already told you that our earnings must always be comparable to the multiple. So if the multiple calculation is based on earnings after interest and tax, then my maintainable earnings must also be after interest and tax. Then, when I talk about maintainable earnings, I'm just referring to earnings that are going to be maintained in the future. In other words, earnings that will be repeated again in the future. So we are going to have to make adjustments in order to calculate maintainable earnings. The first adjustments that we make are for exceptional items or non-recurring items. So this is any income or expense that is exceptional, that you don't think will happen again in the future, because if it doesn't occur again in the future, it is obviously not maintainable. So that must be adjusted for. Exclude anything that is unusual, anything that is exceptional, or anything that will not occur again in the future. And linked to that Obviously, any income or loss on discontinued business operations must also be excluded, because once that business operation is actually discontinued, we won't have that income or that loss again in the future, so it must be eliminated. We then adjust for any income and expenses that are not market-related or reasonable. So when we are calculating earnings that are going to be maintainable in the future, we only take into account income and expenses that are market-related. If it is not market-related, we need to make an adjustment in order to take that into account. Then if we have any changes in tax rates over the years, you should use the most recent tax rate or the current tax rate for all years. Now, it's very unlikely that you'll see this in a question because the company tax rate has been 28% for quite a while. However, if you have different tax rates, in the one year the tax rate is 27%, the next year it's 29%, and in the most recent year it's 28%, you should use the current tax rate for all of your years. And again, think about it logically. We are trying to calculate earnings that are going to be maintainable in the future. And the current tax rate is the best tax rate to use if we are trying to calculate future earnings. Okay, don't use old tax rates, use the most recent tax rate. Then lastly, if we have any income or expenses that do not relate to the company's main business operations, so in other words, anything that is not operating in nature, we will value those assets separately. Now, please note, when you are making these adjustments and when you are trying to calculate maintainable earnings, you should let the question guide you as to the number of years necessary. So you don't only make the adjustments to the most recent year, you use all of the information provided in the question. So I'm now going to go back to our example. In our example, we were given information for a period of 3 years, for 20x4, 20x5, and 20x6. So we are going to use all of those years in our calculation. We are trying to calculate maintainable earnings, so remember, maintainable earnings must be after interest and tax, and we are going to adjust for any unusual items, any exceptional items, anything that's not market related, and we will value all non-operating assets separately. So let's look at this calculation. In step 1, we calculate maintainable earnings. We perform the calculation for all of the years that are provided in the question. And remember, maintainable earnings is after interest and tax. Now we are going to start our calculation with net profit before tax. And my logic behind starting with net profit before tax is I was told all of these items are sitting in net profit before tax. So I'm now going to go through these items again and see if I need to make adjustments in order to calculate my maintainable earnings. So first, we were given dividends on a listed investment, and in note 1 we were told that the listed investment has a fair market value of 180,000 Rand on the 30th of June 20x6. Now please note, the listed investment is not an operating asset. So because it is not an operating asset, we are going to value it separately. So that means the income or the dividends that I received on this listed investment, which are included in my profit before tax, need to be eliminated. And at the end of the calculation, I will value all non-operating assets separately. So if we look at the solution, we start with profit before tax, and then the dividends on the listed investment are excluded from profit before tax because this is a non-operating asset that we will value separately. Then we were given directors' remuneration. So in each of the years, we've got directors' remuneration of 800,000 Rand. However, in note 2, we can see that the director's remuneration is not market related because a fair director's remuneration should be 900,000, 950,000 and 1 million rand. So remember, when we are calculating maintainable earnings, all income and expenses must be market related. So we are now going to have to make an adjustment so that this expense is market related. In 20x4, we are going to have to expense an extra 100,000 Rand. In 20x5, we will have to expense an extra 150,000 Rand. And in 20x6, we need to expense an extra 200,000 Rand. And the cost will then be market related. So a fair director's remuneration, any amount above 800,000 Rand needs to be adjusted for. Then for the inventory write-off, remember in note 3, this was because we had inventory that was damaged by a fire. So this is obviously an exceptional item. We don't expect this to happen again in the future. So we need to eliminate this inventory write-off over here, and we eliminate it by adding it back to profit before tax. But at the same time, please note, the company was reimbursed 158,000 Rand from their insurers, and this is also included in profit before tax. So we need to also exclude that from profit before tax. So the inventory write-off gets added back, and the insurance reimbursement is deducted. We then have profit on disposal of equipment. Now guys, we are dealing with a furniture manufacturer. So anything relating to the manufacture of furniture or the sale of furniture is operating in nature. This company does not sell equipment. So this is not operating in nature, and it needs to be excluded from our profit in 20x6. So profit on disposal of equipment, deduct it from your profit. We then have an impairment on machinery, and once again, this is also not operating in nature, so this cost needs to be excluded. So it will be added back to our profit before tax. However, on the other hand, the impairment of trade receivables or the bad debt write-off, that is operating in nature. If you're a company and you sell on credit, one of the risks of selling on credit is you are going to be exposed to bad debts. So bad debts is something we would expect the company to have again in the future. It's operating in nature, so we are not going to adjust for the impairment to trade receivables. Then lastly, we have interest on long-term borrowings that's also included in my net profit before tax. Now please remember, maintainable earnings must be after interest and after tax. So we are not going to make any adjustment for interest. Don't add back the interest. We want our profit to be after interest expense. Okay, so there is no adjustment. Earnings must be after interest paid. All right, so we then have our adjusted profit before tax. However, we know that not only are my earnings after interest, but it must also be after tax. So I'm now just going to deduct tax at a rate of 28% for all of the years so that I can get my earnings after tax. Let's then go back to the steps so that we can see what you need to do next. So we've calculated earnings after interest and tax. We have made all of these adjustments so that we have earnings which will be maintainable in the future. We have also used all of the years given in the question. We now need to determine whether there is a trend in our earnings. If we have an increasing or a decreasing trend, you need to use the latest earnings figure. On the other hand, if there is no clear trend, we are going to have to calculate a weighted average. Now, please, before we move on, if there is a decreasing trend in earnings, we need to consider whether the company is actually a going concern. Because remember, earnings multiples can only be used as a valuation method where the company is actually a going concern. If the company is not a going concern, then we can't use this valuation method. So as soon as we have a decreasing trend in our earnings, we just need to be careful and ensure that the company is actually still a going concern. Let's look at two examples so that you can see what I mean by whether there's a trend in earnings or if there's no clear trend. In example 1, the following maintainable earnings after processing the adjustments have been calculated for Madison Pty Limited. So in 20x3 they have earnings of 55,000, in 20x4 72,000, and in 20x5 91,000. So in this example, you can see the earnings each year are increasing. Please note, it doesn't have to increase by an equal amount or an equal percentage. As long as the earnings each year are increasing, we've got an increasing trend in our earnings. And if there's an increasing trend, we should use the latest earnings figure as our maintainable earnings. So in this example, because we have an increasing trend, we are going to use the information for the most recent year for 20x5, and our maintainable earnings will be 91,000 Rand. Let's look at example 2. The following maintainable earnings, also after adjustments, has been calculated for Madison Pty Limited. We've got maintainable earnings of 54,000 Rand in 20x3. That then decreases to 48,000 in 20x4, and it increases again to 62,000 in 20x5. Now, we do not have an increasing trend in our earnings. So we can't just take the most recent year and use that as our maintainable earnings, because remember, with maintainable earnings, we are trying to calculate what our earnings will be in the future. Now, there's a risk if my earnings dropped from 20x3 to 20x4 and they increased from 20x4 to 20x5, there's a risk in future years that this might actually drop again. So because we don't have an increasing trend, we need to calculate a weighted average. On the other hand, in example 1, we had an increasing trend. So it's safe to assume that as a minimum, the earnings that this company will have in the future will be at least 91,000 Rand. How do we calculate a weighted average where there is no clear trend? You take the oldest year and you multiply that by 1. The next year you multiply that by 2, and the most recent year multiplied by 3. So please note, the most weight is attached to the most recent year. And the logic behind that is what happened in the most recent year is more likely to happen again in the future. What happened in the past is less likely to happen again in the future. So we allocate more weight to the most recent year. So if we multiply that all out, we get a total of 336,000, and we then need to divide by 6. And the logic behind dividing by 6 is that is the sum of 1 plus 2 plus 3, so that we can get the average earnings for 1 year. So if we don't have an increasing trend in our earnings, we calculate a weighted average. And in this example, we are going to use 56,000 Rand as maintainable earnings in our calculations. We are now going to go and apply this to our detailed example. So we calculated our earnings after interest and tax. We've also made all of our adjustments, and we can see we've got earnings for 20x4, 20x5, and 20x6. My earnings increase from 20x4 to 20x5. However, they then decrease from 20x5 to 20x6. So I can't use the most recent year because I don't have a trend with my earnings. I'm forced to calculate a weighted average. So when we calculate the weighted average, we take the oldest year and we multiply that by 1. The next year by 2. The next year by 3. The most weight is allocated to the most recent year because that is what's more likely to happen again in the future. We then divide all of that by 6 so that we can get the maintainable earnings for 1 year. And I'm dividing by 6 because that's the sum of 1 plus 2 plus 3. I'm then going to use this figure as maintainable earnings in my calculation. Then please note before we move on, in the question, we were given a trailing PE multiple of a similar listed company. And remember, a trailing multiple is just a historic multiple. And I said to you, your earnings must always be comparable to the multiple. So if the multiple is historic, then the earnings should also be historic. And you can see we have done that in this question. We've used information for the past 3 years. This is all historic information in order to calculate our maintainable earnings. So the maintainable earnings is based on historical information, and when we get to step 2, the PE multiple is also based on historical information. So we are being consistent. So you can see that discussion here just below. So that then deals with step 1. We now know what figure we are going to use as maintainable earnings in our calculation.